You've been saving for decades. You've done everything right. And the question I hear most often from people in the years before they retire isn't about portfolio allocation and withdrawal rates. It's about, am I going to be okay? Am I going to have enough? Most people in that situation are thinking about Social Security in one narrow way. When do I file? It's a fair question, but in my opinion, it misses most of the picture. I'm Brian Carlson, a certified financial planner with Summit Investment Advisors in the Twin Cities. Today I want to walk through something that surprises almost everyone in our retirement workshops: how your Social Security benefit actually gets taxed, and how the filing decision you make affects a lot more than just the size of your monthly check. The filing decision you make interacts with every other dollar of income you have in retirement. Getting it wrong doesn't necessarily mean picking the wrong month or the wrong age to file. It means not understanding the tax picture at all. By the end of this, you'll have a clear framework for thinking about this differently. So first off, let's just look at the filing question: when to file. There are hundreds of break-even calculators. Most of them, depending on your situation, are going to give everybody an answer that the break-even age is in your late 70s to early 80s, depending on when you file. Filing at 62, filing early, means you take a real haircut, 30 to 35% from your age 70 benefit. I really try and discourage folks from filing early at age 62 if at all possible. Now, there is some pushback there and say, hey, when I get to 62, I want to file, right? I want to get my money out as quickly as I can. And that's a fair point. I understand that. But then the question becomes, hey, are you just trying to get money out as quickly as you can? Or are you trying to maximize your benefit, right? And if you want to maximize your benefit, a little joke, Social Security joke if there is one, you have to wait till age 70. That's the maximum Social Security benefit you're ever going to get. File at age 70 and you have to live to 100. If you do that, I promise you will get the most money out of Social Security possible. Okay? I know that's not a real answer, and I don't mean to make light of the filing or the timing question. We certainly help our clients with that, but I think the tax impact is the more important point. However, there is one more point to spend time on with regard to the filing benefit, and that's survivor benefits. We're in the risk management business. My job is to make sure that both spouses in a married couple are okay in the worst case. Let's say we have a higher earner that decides to file early at age 62 and take that 30 to 35% reduction. Well, that affects the surviving spouse. In the worst case scenario, if that higher earning spouse then passes away at age 70, that 30 to 35% reduction is now locked in for that surviving spouse. And he or she, the lower earner, is going to be locked into that lower benefit for the rest of their life. We're talking hundreds, if not thousands of dollars a month for 20 to 25 years of their remaining life. I frame it this way: we want you to get your money, the most of it as possible, but we also have to think about, especially married couples, as a team, right? And so I don't see a lot of value in obsessing over the exact break-even age. Whether you file at age 65 and 8 months or 66 and 4 months, that's not the decision that changes your outcome. The tax picture is. And that's what we're going to focus on today. So let's look at how Social Security is actually taxed. And it's called provisional income. And this is something that catches almost everyone off guard. Social Security isn't taxed on its own, just as Social Security income. The IRS taxes it based on other income you have coming in. The formula basically adds up half of your Social Security benefit plus ordinary income, which can be IRA, pension, part-time work, or dividends, capital gains, and then the one that people don't expect, non-taxable interest. Even those municipal bonds that are tax-free income come into play in how your Social Security benefit gets taxed. The easiest way to think about this is the more income you have coming in addition to or on top of your Social Security income, the more tax you're going to pay on your Social Security benefit. The less income you have relative to how much Social Security you have come in, the smaller your taxable portion of your Social Security income will be. And I think this graph will be the easiest way to see that, and that is just the thresholds. And so basically with the taxation of Social Security, you can pay up to 50% or 85%. Everyone can pay up to 50 to 85% taxes on their Social Security income benefit. So if you look at your tax return, and even if you're not taking Social Security, go ahead and look at the first page of your tax return. There's a line in the middle of the return. There's a box in the middle for Social Security benefit received. That's the total received, right? But what matters is what shows up on the right side of your tax return. The right side where all the income items are added up. That's the portion of your Social Security income that's actually subject to tax. The maximum you're going to have is 85% of your Social Security income benefit become taxable. Starts at 50%, potentially zero, but most people at 50, even most people actually are at 85%. Now you can see on these thresholds for single filers, it's not very high at all. $25,000 of that provisional income number or higher, and you're at 50%. If you're at $34,000 of that provisional income number for single filers, you're at the 85% threshold, the maximum portion of your Social Security benefit that's going to become taxable. Same thing, married filing jointly. The 50% threshold kicks in above $32,000, and at 85% above $44,000. It's not a really high level of income these days, and the reason for that is the IRS came up with these thresholds back in the mid-'80s, and frankly, they haven't updated them since. And I don't give them a whole lot of credit that they probably are going to update it anytime soon. So the threshold is low for everybody. So we see a lot of retirees that are hitting that max. 85% of their Social Security income is flowing through to the right side of their return and becoming taxable. So it's something to consider as we go through. And yes, I get this pushback a lot. You are paying tax on Social Security income taxes that you've already paid into. That's just how it is. For those folks that live in the great state of Minnesota where we're located, Minnesota came up with a simplified method to reduce taxes, Minnesota taxes on your Social Security benefit, but that might be worth another video. If you'd like more information on that, certainly reach out to us. So let's move on. This is the next slide we call our tax torpedo slide, and this is where most people sit up a little straighter in our workshop. Here's what happens when you take an extra dollar from your IRA or your 401k in retirement. This example here is pretty standard. We've got a single filer who's got turned on their Social Security income, $30,000 of Social Security income, and then $36,000 from a pension. So $66,000 of annual income, $5,500 a month. Pretty good living. But they're right in that donut hole, or that torpedo zone, we like to say, where any additional dollar that they start to take out of their retirement account, their 401, their 403b, or their IRA, pushes through at a much higher rate. And so, if this single filer in this example says, hey, I want to take the grandkids, I need $10,000, I want to take the grandkids to Disney World. Great, you've saved up. That's what the money's there for. But let's look what happens when you're in this torpedo zone, or the donut hole, as far as Social Security taxes go. That additional dollar that you pull out actually pushes another dollar of your Social Security income over in that 85%. So that 85 cents of your Social Security income is becoming taxable as well. That additional dollar you pull out from your retirement account pulls another 85 cents of your Social Security income to becoming taxable. So in effect, that dollar withdrawal from your IRA or your 401k actually created $1.85 of taxable income. And at a 30% rate, here again in Minnesota, I'd say 22% federal. I'll round up a little bit, but say that we're at 8% threshold in Minnesota, 30% tax rate. So that dollar that you come out becomes $1.85 of taxable income. At a 30% effective rate, you're paying 55 cents in tax on that original $1. The effective tax rate on that withdrawal is 55%. So it's something you definitely need to think about. It makes people set up that trip to take the grandkids. That's great, but it's not going to cost just the $10,000, right? We need to think about the actual taxes and what we're doing as far as pulling additional Social Security dollars to become taxable, so that we're in a much higher effective rate. All right, let's then move on to a real-world example. This is a real-world example that we see quite a bit. I like to call it the new car slide, okay? So we have Greg and Bev. They're both retired, age 65. They've done a great job. They've paid off their home. They're debt-free. The cars are paid off. But they're looking for a new car, hence the name of the slide. They want $95,000 in income in retirement. Pretty healthy income for retirement, but they've done a good job. They've got $1 million saved up between them in their retirement accounts. And they're looking on when they should turn on Social Security. Should they turn on one, both, none? But the overall goal, of course, like most people, is to maximize their returns and minimize their tax bill. And we're happy to help people out with that. But let's look at this. There's a couple of ways that they can create this income. And we'll see this on this chart. They can look at turning on one Social Security benefit. And this is a common strategy. We turn on maybe the lower benefit, in this case, $30,000 of Social Security income, meaning we need to take $65,000 out of one or both of their IRAs to get to that $95,000 target, okay? And as you see, we go through, and the first column there will show you that result of, again, turning on the lower Social Security income and then waiting on the larger one and drawing $65,000 out of the IRA or the retirement account. We've got this first column and how that works out for the federal taxes. Taxable Social Security is $25,500. Taxable other income, i.e. that IRA withdrawal, $65,000, creates total taxable income of $90,500. Now, they're age 65 or older, and so they get the additional deduction as part of the new tax bill. So we've got our standard deduction plus the over age 65 additional deduction, gets their taxable income to $43,000. Even Federal tax bill, $4,664 in that income filing scenario. Okay, now fair, that's decent, I suppose, if we look at that in a vacuum, but there's another way we can look at this, right? But before we move on, I just want to think about this from a rational perspective. If we take a bunch of $100 bills and stack $95,000 on the table next to another stack of $95,000, which will be our second filing option, they should equal, right? Well, not the way the IRS sees it, okay? Here's our second column, same thing, $95,000 of income, we've just changed the way that we've created their income mix. Instead of waiting on the bigger Social Security, we decided to turn them both on. So in this scenario, we've got $65,000 of Social Security income. That reduces what we have to draw from our IRA or retirement account to $30,000 to get to that $95,000 total target. Both Social Security's on, $65,000, $30,000 then withdrawal from the retirement account to get to our $95,000 income target. Again, $95,000 is $95,000 in my book, not in the book of the IRS. We see the column, taxable result at the end, at the bottom, $423. Well, how did we get there? What's the difference? That's a $4,200 tax saving on the federal level. Let's look at it. The taxable Social Security in that second filing option, a little bit lower, $21,725. The taxable other income, in this case the $30,000 IRA withdrawal, gets us our total taxable income substantially lower. And then again, same standard deduction being over age 65, and that standard deduction essentially wipes out most of that taxable income figure so that their actual net taxable income is just over $4,200, federal taxable bill of $420. How did that happen? It's that provisional income, right? It's that provisional income we talked about earlier. The other income, the IRA income, the withdrawal from the retirement account was so much lower that their net taxable income figure, because of the way the provisional income is factored in or calculated, is so much lower. Their tax bill, $4,200 savings on a federal level. Great state of Minnesota, let's say it saved them $1,800, that same filing strategy, about $6,000 in tax savings. That's $500 savings in month, $500 in savings a month. Well, that was enough for them to be able to afford that new car payment that they wanted to get, hence why we call it the new car slide. So what does this mean if you're 5 to 7 years from retirement and still in the accumulation phase? The most common conversation I'm having with people in that window is about building what is called a non-qualified bucket. You've got your 401k, maybe some Roth money saved up, great. But if we can also build up a taxable investment account, a joint brokerage or individual brokerage account that's fully liquid, that opens up a lot more options when you actually get to retirement. The goal here is to create a low income year, or even two, a stretch where basically you don't exist to the IRS. Maybe we're living off some cash or some assets in that taxable account, or maybe like Greg and Bev, we've turned on just one of those Social Security benefits so that our provisional income stays low. In that world, we might be existing in a 10 or 12% federal bracket where it becomes a lot more attractive to consider doing some Roth conversions, where we can maybe push money from our pre-tax 401k or IRA in the 10% or 12% bracket. If we can do that even for just a couple years in retirement, we've got $1 million in our 401k and we're in the 10% or 12% bracket. If we can look at pushing $100,000 maybe over 1, 2, or 3 years over from your 401k over to that tax-free Roth, well, now all of a sudden we're creating a different war chest of tax-free dollars. And having those options, creating not only the 401k, the Roth dollars, but if you can build up the cash or a taxable brokerage account where you have that liquidity, having all those different levers to pull as we get into retirement from a tax perspective is super valuable. This isn't about predicting, again, with Social Security, the perfect filing date. It's about coordinating your income sources deliberately across retirement so that as few of your dollars as possible end up being taxed, right? We want to keep as much money in your pocket as possible, as little in the pockets of the IRS as possible. If this is making you think differently about your Social Security decision or about the tax picture in retirement in general, that's exactly the point. Most people come into these conversations thinking about when should I file, but by the time they leave, they're thinking about coordination of retirement income, about sequencing, about which dollars to spend in which years and why. If you're within 10 years of retirement and you haven't mapped out your tax picture or what it looks like across that period, that's where we'd start. At Summit, we offer a complimentary introductory conversation for people who want to think through this with an advisor. No obligation, just a chance to see what a retirement income plan looks like when taxes are built into it from the beginning. Feel free to follow us for more retirement planning content. Subscribe if you'd like to stay up to date on future videos. Please check out our website for more information.